Dave here, coming to you with another video. Today's Monday. I came home a little bit late, so I'm just going to do some quick summary of what's been happening since the markets have opened today. I wake up typically in European hours, so I'm a little bit ahead of the US markets and the COMEX openings. And if you look at the charts this morning, I would say that overall gold was pretty much flat. And I was looking at my machine learning tool. It was predicting that gold would trend upwards today. And the prediction was today we would reach around 1849, somewhere around that by the closing period. And there was very little weakness in sort of the overall fundamentals of gold. And I was thinking about that. Then the first thing I was looking at the Swiss franc to dollar ratio and the exchange rate. And one of the things I noticed this morning, at least on the 7th of December, early in the morning, we saw like the dollar was already weakening against the Swiss franc. Now, what I've noticed is when the U.S. markets open, typically you see much bigger volumes. You see that when the London markets open, for example, there's a little bit of volume, but when the US markets open, that's when the big trades happen. What I've noticed is that, I did a piece a few days ago. Over the weekend, I said there were some sales of the Dow, especially in the ETF sector. The Vanguard fund, $7 billion was moved out of the fund. It's roughly 4% of the fund, which is quite a lot if you think of how much it is. $7 billion is a lot, but it's very rare for a large sale like that to happen over the counter and especially over the weekend. But it did happen. And, I do have some theories of what's happening. One of the theories I have is that some of the smart money is trying to rebalance their portfolios. They're like a little bit risk off at the moment about the stock market, and also with the dollar weakening. You can see that the dollar is weakening not just against the Swiss franc. It's not just like the Swiss franc is gaining on the dollar. It's every currency is gaining on the dollar. There's even the Japanese yen. The Japanese yen is pretty much flat against the dollar, but even then right now, we're seeing upward pressure pushing the yen, to be more valuable than the dollar. So is the euro. So why is that? Because all of these countries, they're all doing QE, right? They're all doing QE to make sure that they're able to follow the dollar. The Swiss National Bank, right? They've been doing how much? They've been doing 20 billion of foreign exchange interventions since June. That's a lot of money. And since June, they have not been able to devalue the Swiss franc against the dollar. I don't think it's because people are stacking Swiss francs. Because when I look at all the charts, everybody's getting stronger against the dollar. It's just that right now in the market, all investors are, when they can, they're dumping dollars. I think they're doing this, and also in combination with what happened over the weekend, people are dumping dollars because they expect a stock market crash to happen soon. Now, they expect, or they're expecting that the returns on the American stock markets are not going to be as high enough to offset the dollar weakness. This is especially important for international investors. Now you're like, yeah, but the dollar is a reserve currency. Yes, but a lot of international investors, they use and they live in countries that use other currencies, right? If you are a European investor, you'll be using euros. If you're a Swiss investor, you'll be using Swiss francs. If you're a Chinese investor, you'll be using the Chinese yuan. If you're a Japanese investor, you'll be using the yen. And if the Dow Jones doesn't gain, let's say, I don't know, right now we're seeing around roughly the dollar weakening at almost like 0.5% a day, and in some cases it's lost since June almost 15%, 12% against the Swiss franc. So you kind of have to expect that the Dow Jones to make more than 10% in a half-year period, has to consistently and going onwards, it will still make that amount, you know? And I think people don't believe that anymore. It's simply that, you know, for the Dow Jones, who has hit its all-time high of $30,000, for it to continue to make 10% per year, considering the current economic situation, for the stocks to grow at a 10% rate per half year, so 20% per year, while the dollar is weakening, in order to justify for foreign investors to put their money in dollars and then on US ETFs, you have to have strong ETF growth, which people right now looking at the economy and looking at the economic numbers, they're not so like optimistic. They're a little bit doubtful that that's the case. And I think for gold and silver, at least, you know, since the recent dip, when this happened, I was telling people, you know, Black Friday, it's a buying opportunity. It's see as a discount, buy into a bit of gold and silver. I did. I picked up. I think I picked up during this period 4 gold sovereigns. I was like, it was ridiculous a price in Swiss francs. Also, the Swiss franc was getting stronger versus the USD, but gold is gaining on the Swiss franc too. So it's not like gold as a currency, you know, is not being devalued. All the other currencies are gaining on the dollar, but they're doing that while their governments are trying to devalue their currencies. Nobody wants to be so strong against the dollar. Nobody wants to gain 10% on the dollar, because all of a sudden, if they're exporting to the United States, which is the case of Switzerland, they export, I think they have a foreign exchange balance of $42 billion, right? Well, now it's the cost of buying those exports is not going to cost you $42 billion. It's going to cost you $47 billion. So it's going to be like almost $5 billion more for the same amount of exports. Either you're going to export less, or you're going to have to pay more for the same amount of goods. So that's not great for countries exporting to the United States. So all the countries exporting to the United States are doing foreign currency interventions. You have to realize that. But none of those countries are managing to devalue their currency against the dollar. That's a crazy, crazy situation, right? It means that overall investor confidence in the dollar is terribly low. It's horrifically low. If no major other like central bank around the world is able to devalue their currency against the dollar, despite that they're really trying really hard to do it without, they're basically at the limit of being currency manipulators. But but they don't want to go over that line, most of them. So they're trying to, but they're not managing to devalue against the dollar because people are dumping dollars. This is the situation. People are dumping dollars. Why are they dumping dollars? I think because, you know, for you to hold dollars, you don't really want to hold dollars. You want, if you're going to hold dollars in the short term, it's because you want to buy something, right? You might be considering buying oil. You might be considering buying buying gold, buying platinum, buying palladium, buying copper, whatever. However, if you are holding dollars, it's very rare that you hold dollars for the long term. You typically hold it for a short to medium term cycle, and then you buy into some sort of asset, which includes either American treasury assets or stocks, ETFs, indexes, which are ETFs, commodities, which are priced in dollars. However, right now, with the extending dollar weakness, I think a lot of people are going to be dumping. You know, they're going to be dumping. They're going to be dumping. Basically, the core of most of the assets that most of these countries buy is bonds, and also they usually buy U.S. index funds. And if they are dumping U.S. index funds, we could be in for a very, very bad time, because it will compound the sell-off. How will it compound the sell? How does the dollar weakness compound the sell? Well, imagine this. You are let's just take the most sensitive one. You're a Swiss investor. You invest 1 million Swiss francs into the you want to invest 1 million Swiss francs. You look at what's in the market. You look at like 2 years ago. You're like, oh, cool. The U.S. dollar is relatively stable. It's relatively strong, and the U.S. stock market is gaining on all the other stock markets. So it's a good buy to trade your Swiss francs for your 1 million Swiss francs for $1 million. It was a 1-to-1 exchange rate, and put it into for example, the S&P 500 ETF was Vanguard, right? And you put it there and you leave it there for 2 years, you're making like 10-20%. But come this year, right, starting from March, you've left it in the ETF, and the Dow Jones or the S&P 500 crashes due to the pandemic, and then it recovers. But at the same time, the dollar is losing value. The dollar loses 15%. You're going to take a hit on your recovery, and then you're going to realize that you're taking a lot of risk in keeping your assets in the US stock market for very little return. And most likely, you're like, yeah, I don't want to risk my now, I don't know, you made like 30% over the last 2 years on ETFs. So maybe like you were like 1.3 million, you're going to cut your losses. You're going to sell your ETF positions. You're now 1.3 million, $2 million dollar position. And then you pull out and you are like, okay, now I'm buying safe assets because I think, I see that the Swiss National Bank is doing foreign currency intervention. And this has a knock-on effect because as you pull out, you're buying dollars and you're selling dollars for other assets, for example, like gold and silver. It's going to further weaken the dollar. If a lot of investors do this on the open market, it's going to drive the dollar value down, no matter what foreign central banks try to do to their own currency to try and weaken it to the dollar. At the same time, you have the Federal Reserve, which is pumping liquidity into the markets, and that's going to have an effect on the dollar. So when I look at this, when I built my machine learning program to try to do the predictions, told me that the most sensitive currency to this type of a relationship is the Swiss franc, and it's the MACD of the Swiss franc and the direction of the MACD that contributes to whether there's going to be a gold boom or a gold crash. And it holds pretty true. This morning I was looking at it, I was like, oh wow, the MACD is just like, the curve is just going to go upwards. It's just going to go straight upwards. Soon we've changed, like before it was a little bit flatter. There were at times when we dropped below a 100-day exponential moving average. I look at how it correlates with gold. It's kind of like, okay, it does correlate with gold. There was drops during that period with gold, but overall, the trend for gold should be still positive. We should still see a positive growth for gold. I think anytime we're getting close, this line I drew is supposed to be like sort of representing roughly the 200-day exponential moving average for gold. As long as we're around this line, and back here, this is 1790. If you dip below this, it's a buying opportunity. They call this, I've been doing a little bit of research. They call this like sort of a gold super cycle, and it's kind of like it's not so much that it's a gold cycle, it's a currency crisis cycle, and we have this every single few years where the central bank needs to adopt a policy, a more liberal, like a more dovish policy. That's what they call it, and they do quantitative easing, a lot of quantitative easing for a very long period, and usually it lasts until they can no longer do it, and then they instantly revert and then increase interest rate to 20-30%. This is what happened when I think it was during the New Deal. Anyways, it's history lessons, but there are cycles. We're probably at the start of a very long upward trend cycle. We came out after 2008 during a sort of down lower cycle where Jerome Powell tried to increase interest rates to reduce asset inflation, which was something he could do. It was probably the right move at the time. If there was no pandemic, he would have kept on doing it. He would have kept interest rates a little bit higher to try and reduce the balance sheet of the Federal Reserve, to reduce monetary supply and to cool off the markets somewhat. People would have not been happy, but that was kind of the right thing to do. But now I don't think they have a choice. They're like, yeah, the economy is in the drain. What do we do? Well, we've got no choice but to print money. What's going to happen when you print money with the world's foreign reserve currency, of which all commodities are nominated in? Well, they're going to explode. All your commodity prices are going to explode like crazy. However, they're not going to be cost. They're not going to cost so much more for foreign companies who are making products. It's just that it's going to tank the ability of U.S. producers in purchasing those products. That's something you have to keep in mind. It's going to drive up primary costs for producers in the United States. It wouldn't be so much of a problem if that money went, whatever they did in QE and all of the money printing, a lot of it goes directly to households who are able to purchase. But yeah, we're probably not going to see that, and it's going to be quite an interesting situation. I have no idea where gold is going. However, it does look like at this moment, the short-term MACD is kind of like still downward trending. We still have a gap, but this sign, when you have a flat and then it starts reverting, this sign is typically, the start of when you have a much longer reversion, and typically it goes on for about, I would say, the reversion goes down, the inversion, goes for about April to September, end of August, for about 180 days, roughly 180 days. And typically you could see, especially if the dollar weakens so much, you could probably see 2,000 plus 2,100 gold in 180 days. I did make a prediction. I think earlier I said, by early next year, we might see $2,000 plus gold. I think I said by March. I said by February, March, before May. Essentially before May, we might see higher gold prices. Does it mean you need to back up the truck on gold? No, I don't think you should back up the truck on anything. I think that, ease in a little bit right now. You can buy a little bit. I bought a little bit during the dip. When my next paycheck comes, and if I see that there's a confirmation and we're heading up higher, I'm gonna stack more. I'm waiting for platinum to drop a bit because I think it should drop a little bit before it had a really good run. I bought platinum back when it was 800, I think $850. I wanted to buy it a little bit earlier, but trying to buy physical platinum it's almost impossible. Like right now, like not right even right now. Like when I would say 2 months ago, I was able to buy one platinum lunar ox coin, and then a week before I got my paycheck, they ran out. I was like, what? I wanted to buy my second one, and after they run out, they're gunning for like $1,000 plus platinum, and I was like a little bit disappointed. I was like, yeah, that was not cool, but that was my buying limit. So I do set myself limits of how much I should buy because I don't know which way the markets go, and if you're stacking, you can't short markets. You don't have a high liquidity, so you have to be very, very conservative. And sometimes you get good deals. And when I bought the Platinum Ox, it was a good deal. Right now, if I sold my Platinum Lunar coin, I would have made, it wiped out the premiums. It's even wiped out the tax amount, but definitely it's worth more than what I bought. It very quickly turned around. Gold, I've been buying, I would say, during the whole period from September all the way till December. And I think silver is on the same path. I mean, silver, most likely, I haven't done the calculator for silver. I haven't done the machine learning program for silver. I'm working on refining the machine learning program on gold. And then, because it's a much more stable asset, it fluctuates less. And then I will work on the one for silver and platinum, because platinum also is a little bit different. So I might tweak a little bit. I might tweak a little bit the type of inputs I'm putting into it, and then we'll see what's most, I would say, important in terms of the direction of gold, platinum, and silver. Also, I did notice something very interesting. Let's go into the Japanese yen. Let's see, indicators, Nikkei. So I do have the, I can't see it, whatever. So I have the Nikkei in one of my newer indicators since I added the rate of change indicators. I'm doing some testing with my machine learning program. I noticed some people who have built their programs with certain information such as rate of change, they were able to get better results out of their machine learning programs. And I'm going to be including that and doing some testing. I'm not sure how accurate that program will be, but I'm building it and I'm testing it. And if it works out, and I get a much more accurate predictor, that's great for everybody. And I'll be able to give you better guidance on what I think the market might do. Anyways, I've been told that I talk too much in my videos, and I'm gonna keep my videos short. So we're gonna keep it around under 30 minutes. We've gone on already 20 minutes. If you like the content, click like. It helps me out a lot. So sub, click the bell notification button. Thank you very much for watching. Keep stacking and stacking good health. Dave out.